Thank you for joining today's webcast. Your moderator for today is Ms. Marlis de Ruyter. Ms. Ruyter, you may begin.
Hello, everyone, and welcome to this Thought Center webcast. It will be the first in a series of 6, and it will be about navigating in the post-BEPS world. And as said, I'm Marlis de Ruyter, and I'm your moderator for today. And on a daily basis, I'm also EY's International Tax Services Tax Policy Leader. I joined EY 5 months ago or so, and before that, I worked at the OECD, and I was in charge of the Transfer Pricing and Tax Treaties division. And during my time there, I was in charge of drafting all the tax treaty and transfer pricing OECD G20 BEPS reports. So talking about these reports, what we have seen is that the OECD BEPS project has moved rapidly from design to implementation and is leaving a fundamentally changed landscape in its wake. And we would like to help you navigate this still a very changing landscape in a series of 6 webcasts. These will give you a comprehensive overview of where we are, where we're heading, and we will also give very special attention to the practical implications that this will be having for business. So today will be our first, and today we will give you a very broad overview of where we stand at the moment. If you would like to register for the others, please kind of look at our website and then /webcasts, and you can also get there by clicking on the green resource list button at the bottom of your viewing console. So with the subject introduced, I would also like you to meet the panelists for today because we really have a terrific panel for today. And I first would like to introduce Susan Pitter, and Susan is from EY Frankfurt. She's our EY EMEA Tax Deputy Leader, and in this role she advises on inbound investment into Germany and has considerable experience working with US and UK headquartered groups. I'm very glad you could join us, Susan.
Thanks, Marlis. Great to be here.
So next up is Kathy Koch, and Kathy is our EY's America's Tax Policy Leader. And before she joined EY, she was the Chief Policy Advisor to the Senate Majority Leader for Tax and Economics. And in that capacity, she also led business outreach for the leader and also for the Democratic Caucus. I'm very happy that you could join us, Kathy.
Well, thanks, Marlis. I'm happy to join.
So as a third, we joining from the Asia Pacific region, we have Joanne Su. And Joanne is our Asia Pacific Transfer Pricing Markets Leader. And she has extensive experience in Chinese transfer pricing, and she's also a trusted advisor to more than a dozen global and U.S. Fortune 500 companies. Welcome, Joanne.
Thanks for inviting me, Marlis.
And then finally, joining us all the way from Australia, so he's in the middle of the night doing this webcast, Sean Monaghan, and he is our EY Oceania International Tax Services and Transfer Pricing Leader. And he has 20 years of experience in advising Australian but also foreign-based companies on taxation issues in relation to the region and international tax issues. So welcome, Sean, to the webcast.
Thanks, Marlis. Looking forward to the discussion.
So that introduced our really terrific panelists. And with that said, I would like to turn to the agenda. And if you look at the agenda, you will see that today we will start with a very broad scene setting, and after that we will go into kind of first the G20 OECD BEPS project, where does it stand, what's happening there, and then we will focus on different regions, starting with Europe, then going to the US, and then finishing up with the Asia Pacific region. But before we start the discussions, and to also get you into the right mindset, I would first like to ask a polling question. And that question now on the screen says, do you find it difficult to keep up with the new developments and requirements in all countries? And you can select one of the answers that is coming out on the screen, and then we will come back to the results in a couple of minutes. And you will see these polling questions coming out on the screen throughout the webcast. And if you want to get CPE or CE credits, it is necessary that you answer these respond to these polling questions. So if that's important to you, please keep your eye on the screen for the polling questions. So with that said, I would now like to turn to our first kind of topic on the agenda, setting the scene. And I would like to turn to Susan. So Susan, what is happening in the international tax debate at this moment?
Yeah, thanks, Marlis. Well, we've seen a fundamental change in international tax over, I would say, the past 4 years. We've left an era where international tax was not on the radar screen of the media or even not the particular focus of the board, to one where tax is now more than ever a topic for boardroom agendas and for public scrutiny. Unfortunately, it's become a headline subject in the mainstream media. So every negative comment on international tax planning by, for instance, a non-government organization, every revelation of leaked information on tax structures, every publication on a new state aid ruling really leads to public outcry and to even deeper scrutiny. So, as you know, the policymakers and governments acted fairly quickly in 2013 to tackle what was labelled to be base erosion and profit shifting, so BEPS, by introducing the OECD G20 BEPS project. And this political support drove the project to the adoption of the final BEPS reports, which you just referred to, in October 2015, and to a wave of relatively swift implementation measures. So over 90 countries are now committed to the implementation of the BEPS outputs. And in fact, political pressure, coupled with the pressure from the media and from the general public as a whole, have driven some countries to move quicker and in some cases to actually go beyond the G20 and OECD agreements. So in the meantime, the BEPS outputs have been implemented widely. During the course of 2016, we saw a lot of activity, in particular the new country-by-country reporting obligations, and we actually expect to see more implementation throughout the course of 2017 and 2018. And it's quite interesting dynamic. The European Commission has taken on the implementation within the EU with real dazzling speed and enthusiasm. It's used quite strong words and has really positioned itself as the organization to take on the big multinationals to address tax avoidance. So it's used the tax avoidance agenda to help drive its own harmonization ambitions. And in fact, Pierre Moscovici, the EU Commissioner who is responsible for tax, recently said that he welcomed all the leaks, as each leak leads to a refreshed momentum to tackle what he perceives as being tax avoidance. So with all this attention and driving force, the BEPS project is really now well underway in realising the ambitions that were set by the political leaders in 2013. So looking at here and now, unfortunately, the continuing focus in the press on the leaks and on the state aid cases relating to structures that to a certain extent were set up way back in the past. This continuing focus creates the impression that to the public that not much has changed, and the related publicity gained from exposing tax structures means that stakeholders such as the NGOs and such as some politicians aren't really incentivized to acknowledge the developments that have actually been made, and I think this is really hindering the economy going back to normal, to a stable and predictable environment that fosters the economic growth that we need, and actually which is advocated by the OECD. If we don't move back to a normal, albeit a new normal, there could be a danger that multinational groups are going to be continued to be exposed to this excessive publicity and public scrutiny of their tax affairs going forward.
And Susan, what will then the impact be of the new Trump administration, and what will the impact on the overall tax agenda of that?
Yeah, so that's an interesting question, Marlis, and I'm sure we're going to hear more from Kathy later on that. But of course, the tax agenda in 2017 won't just be influenced by BEPS and what the EU and other countries are doing, but also I suspect it will be dominated by the new US government. The Trump administration has indicated that it will take on tax reform as a priority, and actually over the last couple of days we've already heard murmurings on the corporate tax rates and what's going to happen there. So for me, a key question is whether this reform, this US tax reform, is going to be aligned with the international agreements reached under the BEPS project, or whether it's going to deviate from that. And it will also be interesting to see how the, let's say, tensions on tax between the US and the EU develop, in particular as more state aid rulings and cases, developments on the third country hybrid structures, the public country-by-country reporting as they come out in 2017. So very interesting times ahead of us, I would say. 2017 is going to be really important year for multinational companies from a tax point of view, and I think it's going to show whether we're going to move towards a more predictable and stable environment in future, or whether the international tax environment is going to be continued to be really turbulent and unpredictable.
Yes, that's indeed the key question. So this is probably also a good time to go back to the polling results. The first question we asked is whether the audience finds it difficult to keep up with the new developments and the requirements in all countries. And if we look at the polling results, what we see is that there's a majority really saying, a big majority saying I find it very difficult. There's 22% saying, I'm actually up to date, but the rest says, it's too difficult to keep up. So what's your view on that, Susan?
Well, it is a struggle to keep up, and that's going to continue, I think, as more and more legislation comes. It will be individual domestic country legislation. It will be wider directives from the EU. So I'm quite impressed with the number that said, yes, I am up to date. But clearly everybody realizing that there's so much going to come out in 2017. So I'll do a little quick advert, because we do have a number of tools and resources at EY that will help people to keep up to date. You can find those in the webcast materials, but I would like to highlight our interactive BEPS developments tracking tool, which will help people to keep on top of this tsunami of legislation.
Yeah, that's definitely a good advice. So now we've had the setting of the scene part. Let's move to the first kind of focus area, which is the OECD G20 developments. But before we go into the content on that, I would like to ask our next polling questions. So our next polling question, it relates actually to Susan's setting the scene part. So, and the question is, to what extent does your company consider reputational risk when deciding on tax planning as part of your company's tax policy? And again, the answers are on the screen, and we will come back to this later on in the webcast. So while we wait for the polling results, let's now start with the overview of the OECD G20 developments and its implications for 2016 and 2017. And to me, there are three key questions here. And the first is, what will be implemented? The second is, who is going to implement it? And then the third question, when can implementation be expected? And if you look at this slide, what you will see, so in order to look at this, we really need to go back to basics on kind of what the OECD has done. And if you look at the slide, you will see the three pillars on BEPS. So you will see the coherence pillar, the substance pillar, and the transparency pillar. And these pillars say something about what needs to be introduced, and more importantly, how. So the coherence pillar sees two links between domestic tax systems, because differences in the domestic tax systems are identified as opportunities or gaps or possibilities to create gaps. And these gaps could lead to behavior that was perceived by the OECD G20 as aggressive tax planning. And the OECD G20 wanted to target this, and they did this by making proposals for countries to amend their domestic law changes, their domestic tax systems, which is reflected in the color yellow in the boxes. So if you look at these proposals, and actually there are no obligations here. It's best practices, it is common approaches, and only on harmful tax practices there is an obligation, there is a commitment, there is a minimum standard. Because you need to exchange your rulings and you need to fulfill kind of the minimum qualifications on the patent box. So that's the first one, mainly through domestic legislation. Then the second one is the substance box, and this one goes to the international tax norms. It relates to the Model Tax Convention, and it relates to the interpretation of this Model Tax Convention through the commentary, but also through the transfer pricing guidelines. So we first look at kind of the changes to the Model Tax Convention, preventing on treaty abuse, avoidance of permanent establishment status. These changes will need to be made in the bilateral treaties. So you will need treaty changes to do that, and that can be done in two ways, either by bilateral negotiations or through a tool that has been developed by the OECD, that is the multilateral instrument that will update a lot of bilateral treaties at the same time, and we will come back to that. So then the second category, which is the interpretation of the Model Tax Convention, that part, is just interpretative guidance, and actually it becomes applicable at the moment that it is communicated that this is the shared kind of interpretation of all the countries that are in this project. So at the moment that the OECD G20 reports were published, actually the transfer pricing guidance already became applicable. And it depends whether a dynamic interpretation is allowed in a country, whether it will be applicable as of now or will also be applicable with a retrospective effect. With all these substance changes, it's very important to realize that these tax treaties don't give taxing rights. So the domestic legislation of countries needs to allow for taxation in accordance with these international norms. If that's not the case, countries may need to change their domestic legislation in order to create that alignment. So that's the second pillar. Then the third pillar is on transparency, and here you see kind of many colors because there are three kind of pillars in this pillar actually. The one is getting more data on base erosion and profit shifting, which is more kind of a theoretical exercise, kind of getting access to data, making sure that countries can assess whether BEPS is going on at an earlier stage. Then the second category is creating better access to better information for governments. And that can be done through kind of disclosure rules, to improving transfer pricing documentation, country-by-country reporting, and for those who definitely need domestic legislation. And then the third pillar on transparency is enhancing kind of dispute resolution mechanism, because it's recognized that there will be a lot of uncertainty and possible disputes resulting from BEPS, and therefore these dispute resolution mechanisms need to work perfectly. So if you look at that, you will see that you need different approaches, different kind of ways to introduce this for these different kind of pillars. Then there is also two horizontal kind of actions: the digital economy, which is just kind of looking at, which is just a report looking at, how the digital economy impacts the current international tax norms. And then there's the multilateral instrument, and as that's the tool through which countries can implement the BEPS changes in one go in all their bilateral treaties. And we will come back to that later. So that kind of answers the what question in relation to kind of the OECD G20 project. And before we go then to the who question, it may be good to first cover, the polling question that we asked before I started, That one was on the reputational risk, in how far it was considered. And Susan, what did the responses indicate on that?
Yeah, Marlis, so actually not really a surprise for me. So only 15% of those who responded saying that reputational risk is not really a focus when their company is deciding on tax planning. And so that means a whopping 85% saying yes, they do take account of reputational risks when deciding on tax planning. So not really a surprise, but certainly if you look at the change over the past few years, this is certainly heads of tax now have a new concern in addition, an additional item on their agenda that they have to manage and that they really didn't have to think about very much in a pre-BEPS world.
Yeah, indeed, not a surprise. So now let's go back to the what, who, and when section. And the next question I would like to answer is who. So who will be implementing? Sean, can you shed some light on that?
Yes, certainly, Marlies. I guess to answer your question, at this stage, 94 countries have committed to the BEPS outputs, and it's expected that this number will continue to grow. Before the BEPS project commenced, the OECD had 34 member countries, which were representing a shrinking share of world trade. Post-BEPS, the OECD and G20 had been brought together. The number of participating companies had grown to 46, which included the larger emerging BRICS economies. This group represented more than 90% of world trade. After the BEPS reports were adopted and published in October 2015, Latvia became the 35th member of the OECD, and the OECD invited all jurisdictions to participate and commit to the implementation of BEPS by becoming a member of the inclusive framework. As it currently stands, 94 countries are part of the inclusive framework, and those 94 countries are covering in excess of 90% of the world trade. So it's a fairly broad uptake of countries across the globe, Marlies.
Sean, yeah, it's indeed good to realize how widespread the BEPS commitments are. And this also means that there is still a lot of implementation to come. So now we have answered the who question. It's important to also look at the when question. Joanne, when will the new transfer pricing rules become applicable?
Well, Marlies, the issuing of rules can be a complicated process in some countries, and the rules issued are so far in relation to Action 13. However, some countries like China, for example, have started to apply the principle of BEPS already. In certain situations, they even have retrospective effects. As you said before, the guidance in the transfer pricing report constitutes interpretative guidance to tax treaties. This interpretation applies from the moment of publication of the transfer pricing BEPS report in October 2015. For some countries, the update of the OECD transfer pricing guidelines in March 2016 may be the relevant date. However, if a dynamic interpretation of treaties is allowed in a specific country, it may be that the guidance has retrospective effect for all open tax years. Such retrospective effect can only occur if the specific country also has domestic legislation in place allowing taxation according to the new transfer pricing rules. If not, domestic law changes are needed. The new guidance will already be relevant to all pending mutual agreement procedure or MAP cases.
Yeah, so the transfer pricing changes may already be applicable, depending on the domestic rules. So for treaty changes, more work is needed before they can be introduced. And the multilateral instrument was developed specifically to speed up that introduction. So, Susan, what can we expect from the multilateral instrument, or the MLI, as they call it?
Yeah, Marlies. So, as you know, the mandate for the development of a multilateral instrument on tax treaty measures to tackle base erosion and profit shifting was introduced in BEPS Action 15. The four areas covered in the MLI and for which it sets minimum standards are treaty abuse measures, so Action 6, hybrid mismatch arrangements under Action 2, amendments to the definition of a permanent establishment under Action 7, and dispute resolution under Action 14. And let's be sure here, the MLI is a key part of the OECD's BEPS initiative, as it will enable countries to implement tax treaty BEPS-related measures across the existing network of treaties without them having to bilaterally renegotiate each treaty. And that's really important because with over 3,000 bilateral and regional tax treaties in force, it would otherwise take years for that renegotiation to happen, and therefore this is a really crucial step. The MLI is a flexible instrument. It allows countries to opt in and to opt out of provisions and to make choices that are really suited to them. It was published in November last year. It's open for signature now, and as there's going to be a large OECD signing ceremony in June in 2017, that's when we expect that many countries will sign. It enters into force after the 5th signature, but due to more complicated ratification procedures, it might take some time before it comes into effect. So it's expected that those treaty changes under the MLI will probably enter into effect in a broad fashion in 2019, perhaps with some early adopters in 2018. So governments are currently preparing the lists of treaties to be covered by the MLI and currently selecting their options. And I think we're going to have a separate webcast dedicated to the MLI later on in this series of webcasts.
Yeah, we will indeed. So this means that the transfer pricing changes may already be applicable. We can expect broad applicability of the treaty-related BEPS changes as of 2019. So are things also moving this quickly when looking at the domestic law changes needed to implement BEPS, Kathy?
Oh, definitely, Marlise. I think 2016 can be seen as the year of broad introduction of country-by-country reporting obligations all across the world. At our last count on January 16th, 37 countries have adopted country-by-country reporting, and 13 other countries have draft legislation pending. That's really impressive. Taking into account that the remaining members of the inclusive framework and or the EU are expected to introduce provisions, and also other countries are undertaking consultations, we may see more than 100 countries introducing this requirement. Besides that, EU directives have been put in place with the aim of implementing the coherence and transparency-related BEPS measures in the EU in a swift and coordinated fashion. Susan will come back to all this. For 2017, eyes will be on U.S. tax reform.
Yeah, and of course you will be kind of dealing with that later on. So indeed a lot of interesting developments, and it will be important for stakeholders to be reassured that governments will not be overly ambitious in the implementation. The OECD has put in place peer reviewing to prevent that. Sean, what is expected there?
Marlise, as is generally the case, you're likely to get different responses depending upon who you speak to. Some people have great expectations of the peer review process and believe it will be a clear mechanism to provide dispute resolution or a mechanism to improve dispute resolution and MAP processes. Others will have the view that the OECD and G20 commitments are merely soft law, that will not lead to much. If we look at the facts, though, the OECD has put in place peer review processes in relation to 2 minimum standards, and it's expected to introduce 2 more in relation to the other minimum standards. The peer review process in relation to Action 14 on the mutual agreement procedures is fully in place. There is a more lenient review for developing countries, and business input is requested on a country basis targeted towards some of the issues that the OECD cannot assess independently. A similar process will be established for country-by-country reporting. The peer reviewing process has proven in some cases to be an effective mechanism to ensure countries keep their commitments. If we look at the area of exchange of information, peer pressure and peer reviewing has contributed to the abandonment of bank security and has played a key role in the implementation of the global standard on automatic exchange of banking information. So I think certainly the peer review process does give some hope to change, Marlies.
Yeah, brilliant, Sean. Yeah, and it will indeed be interesting to see how much trust our presenters in the next webcast will have on the peer review mechanism on MAP. So for this webcast, we now have the answers to the what, how, and when questions, and that actually brings us to the next section, which is on Europe. But before we go on to the content on the European part, I would like to ask our next polling question. And this polling question really kind of relates to what we're going to talk about in the European section. So the question is, have you started reviewing your rulings and assessed potential areas of risks under the EU state aid and BEPS environment? And again, you can choose from one of the answers that are up on the screen, and we will come back to this question later on. So while you're answering this question and the results are being compiled, let's start with the EU perspective. Susan, can you start by painting an overview of what the most important developments relating to the BEPS implementations are in the EU?
Yes, Marlies. So even prior to BEPS, the European Commission was focused on eliminating harmful tax practices and unfair tax competition in order to establish and protect the EU single market. So the OECD's BEPS initiative very much complements this objective and promotes the transparency and the fairness that the EU is seeking. And so this goes some way to explaining why the EU has been such an enthusiastic supporter and advocator of BEPS, and also explains why we're seeing the EU vigorously implementing BEPS and in some cases going further than the OECD's recommendations. So with this context in mind, the EU has either introduced or is exploring the introduction of a number of different measures that have a BEPS-related focus. So I'll talk about some of these in more detail later on, but as of an overview, I'll just list a few. So they include very early on in the proceedings the introduction of a general anti-avoidance rule into the EU parent subsidiary directive relating to the taxation of dividends, the introduction of the anti-tax avoidance directive, as well as an EU country-by-country reporting directive, translating Action 13 into EU law, an EU-specific exchange of rulings directive, a proposal for a mandatory and binding arbitration process, a proposal to make public certain elements of country-by-country reporting, and last but not least, a proposed common corporate tax base, which may eventually lead to the introduction of a common consolidated corporate tax base. So to mention just a few of the current activities and just to give you an idea of just how much is being pushed and driven by the EU, in particular the Commission.
Yeah. Since I joined EY, I've experienced that whenever these developments are painted in meetings with, in particular, non-European clients, the underlying dynamics were perceived as really complex. It may therefore be good to reflect shortly on the competencies of and the interactions between the following three actors that we see within the EU. So how are the relationships between the member states, the European Commission, and the European Parliament, so that people can put a bit of a perspective on the European developments in the area of tax? So Susan, can you shed some light on these institutions?
Yes, I can. And so if the Europeans can bear with us for a moment, who are probably more familiar with this, I'll just do a real high-level explanation of those three. So obviously there are 28 and soon to be 27 European countries in the European Union, and we refer to those countries as member states. and they are represented in the EU Council, the main decision-making body of the EU. Then we have the European Commission. It's the executive arm that submits proposals for new legislation to the Council and to the European Parliament. It ensures compliance with EU law, implements policies, and I think we've seen it live in the last few months, playing a watchdog function for the implementation of EU policies. And then we have the European Parliament. It's the legislative body making the laws as proposed by the European Commission, but only in specific areas. So probably interesting to note that in direct tax matters, the European Parliament only has the right to be consulted. The power to levy direct taxes is central to the sovereignty of the EU member states. So the EU only has limited competences in this area, and under the EU tax treaty, direct tax measures must be adopted unanimously by the member states.
So now moving from the process to the substance, Susan, what is the status of the ATAD? Do you think we will see implementation in 2019?
Yes, the ATAD is the EU's anti-tax avoidance directive, the immediate response of the EU to the BEPS project. The ATAD will ensure consistent application of BEPS across the EU and relates to a number of the BEPS measures, including CFC, Controlled Foreign Company Rules, under Action 3, interest limitation under Action 4, and hybrid mismatches between EU member states under Action 2. It goes over and above the BEPS measures by also introducing exit tax provisions and a general anti-abuse rule. So the ATAD was agreed in July 2016. It must be implemented into the member states' national legislations no later than the 31st of December 2008 and will therefore mainly take effect from the 1st of January 2019. It sets out minimum standards on these 5 anti-abuse measures for EU member states. But national implementation might go further, and it's also worth noting that there is a derogation which could apply to the interest rate deductibility limitation rule and to the exit taxation rule. But actually, the EU Commission is now putting further proposals forward to continue countering what it views as aggressive tax planning with a second ATAD phase, the ATAD 2. So in addition to extending the application of the rules on hybrid arrangements to apply not just within the EU but also to arrangements between EU and non-EU, so third countries, it's also more encompassing than the ATAD 1 or the original ATAD as far as hybrid arrangements are concerned, and that it also covers permanent establishment mismatches, hybrid transfers, imported mismatches, and dual resident mismatches, which were all not included in ATAD 1. So it really will bring the rules into line with the OECD BEPS report on Action 2, and it will also potentially enter into force together with ATAD 1. It's like an amendment to ATAD 1, if you like, from 1 January 2019.
And are we also going to see public country-by-country reporting in Europe?
Okay, well, that's a tricky question. It currently looks less likely to happen. So, as you know, Action 13 of the OECD's BEPS measures introduces the requirement for companies to undertake country-by-country reporting, and it has been already translated, as I mentioned before, into the EU country-by-country reporting directive, already adopted in May 2016 and due to be implemented in June 2017. But taking the work of the OECD a step further, the European Commission issued a proposal in April last year that would require large multinational companies operating in the EU to draw up and publicly disclose certain elements of their country-by-country reporting. Broadly, it would affect companies or groups with consolidated revenues of over 750 million euros. Recent developments suggest that introducing this public element to the legislation across the EU would require the unanimous consent of the member states, so seen as an amendment to affecting direct tax. And I think this is unlikely to be achieved, actually. There are some fundamental constitutional issues on this that have come up in France. There are issues in Germany, and several other member states have already voiced objections. So certainly my personal opinion is that I don't see this coming really in the next year or so.
And then moving to state aid. The state aid discussions have raised a lot of debate over the past year. And as the European Commission for the first time has applied state aid to implementation of tax rules through rulings instead of to the legislation itself. So many have raised questions with the analysis put forward by the European Commission. So what is your perspective on where the developments on state aid and tax stand? What can be expected in the coming months?
Okay, so eliminating harmful tax practices and unfair competition, as I said before, is really an ongoing focus for the EU. So targeting member states and multinational companies that have allegedly received illegal state aid is really striking right at the heart of this objective of the European Commission. And I think it's likely to continue to be a focus of the Commission going forward and in the near to mid-future. Obviously, there has been a number of recent high-profile EU state aid cases on tax matters, with a particular focus, or it appears to be a particular focus, on large inbound US-headquartered multinationals. I think it's unlikely that the EC has specifically targeted the US. There are non-US examples. I think the fact that US multinationals have been affected potentially more than others is more of a result of the current US domestic tax legislation, and it's so because of that more likely that the US multinationals have sought the type of rulings that are now being challenged under the state aid concept, and rulings that probably wouldn't have made sense for EU headquartered companies, in particular looking at the CFC rules that are in place within many EU states. So current state aid cases are generally challenging transfer pricing or profit allocation rulings granted by individual member states to a taxpayer, rather than challenging the underlying legislation, which was what we previously saw in state aid challenges. So at the moment we can see that the state aid cases mainly relate to the Netherlands, Luxembourg and Ireland. The original inquiry actually in 2011 related also to UK, Cyprus and Malta. I've also seen some movements around Gibraltar, and actually the inquiry is extended now to include all member states. And as more information has emerged about the state aid cases and as more cases are being heard, it's becoming increasingly clear that the European Commission isn't really looking to establish its own arm's length principles that are different from those of the OECD. It's really questioning whether the transfer pricing arrangements that were put in place under the rulings were acceptable, so whether those arrangements actually reflected arm's length principles. The European Commission also seems to be upholding the view that the arm's length principle must be followed, even if it hadn't been implemented into a particular domestic legislation of that member state at the time of the original ruling, which, of course, Ireland would be a good example there. So there's a real concern that the European Commission is taking today's BEPS standards and today's view of the tax world and applying these principles to fact patterns that were established long before BEPS was even heard of. I call it the BEPS tinted spectacles, and there's no doubt that across Europe and the EU in particular, we're seeing the application of BEPS principles in current tax audits by the national tax authorities to fact patterns that existed significantly prior to BEPS, and this is a concerning reality across the EU.
So more cases will follow, and we will see more information on the rationale behind cases that were already ruled upon. What is the time horizon by when we will know whether the rulings by the European Commission will be upheld?
Well, all of the decisions so far issued by the Commission are being appealed by the Member States and by the multinational companies involved. So assuming that the appeals process continues ultimately to the European Court of Justice, then I think it will be at least 4 to 5 years before we know whether the Commission's decisions are going to be upheld, and some of those cases will take even longer than that.
And that means that business is experiencing great uncertainty at this moment because of the state aid procedures. And given the argument used by the European Commission effectively means that legislation is interpreted totally different from the way business understood the legislation to be at the time of setting their transactions. So with that, many businesses are now assessing whether they are exposed to tax state aid risks. Given that clarity on the outcomes of the procedures will only come in, like, say, 4 to 5 years, will it even matter at that stage whether the European Commission is proven to be right or not? What is your advice to business confronted with this uncertainty?
Well, the European Commission, is already expected to consider more state aid cases, so momentum is increasing, and it's not going to wait for the outcome of the first batch of cases before it pursues the new ones. So expect that scrutiny and those challenges to continue, even though we don't have a decision of the European Court of Justice in the meantime. And if the EC decides that the member state has granted illegal state aid, the member state typically has only around 3 months to issue the taxpayer with a tax assessment for the outstanding amount. And the Commission can go back 10 years to recoup the unpaid taxes. There may be interest charges, so the amounts involved can be really substantial, and the exposure would have an immediate impact on the company's books. So I really want to stress how focused the European Commission is on targeting state aid, and how important it is that businesses are really addressing their risks in this area, really because huge amounts could be at stake. So my advice to businesses is to be proactive and be prepared. If you have rulings, if you have APAs, or even if you have more informal agreements with EU member states, then review them. Try to understand whether there is a risk that could constitute illegal state aid under the relevant EU rules, and then also what the consequences, in particular the monetary consequences, might be, and agree a plan on how to address this risk. So make sure you're revisiting your transfer pricing documentation on a regular basis. Also consider, does it need to be enhanced and updated? Also, really important, don't deal with individual country tax audits and state aid in isolation. You need to take a globally holistic approach to this type of tax controversy to make sure that a solution that works in one jurisdiction doesn't jeopardize your position in another jurisdiction, or even at EU level.
Yes, I totally agree, Susan. So now may be a good time to also look at our poll results, which kind of link to this question. The question related to whether kind of the audience has started reviewing their rulings and have assessed potential areas of risks under the EU state aid BEPS environment. And looking at the answers, it's an interesting split, because we have as many kind of saying, yes, we're reviewing, as those saying, no, I have not yet started reviewing. So it's a kind of 40%, 40% split. So that's interesting, and definitely those saying no are not totally aligned with the advice you are giving. So let's now finish up this section. I would like to talk a bit about further EU development, Susan. We're a bit behind on the time, so I would like to do that very briefly. What can you say on the expectations in relation to the CCTB and the CCCTB proposals? Will we see that in the coming 5 years or so?
Well, apart from it being a real tongue twister and having to get your tongue around the 2 C's and the 3 C's, I think we're not necessarily going to see this. So the Common Consolidated Corporate Tax Base was originally proposed in 2011, and it stalled because of sweeping objections from a number of member states. Of course, it's now been fueled again by the momentum of the BEPS discussions, and the Commission has relaunched its proposals for a common corporate tax base and a common consolidated corporate tax base, relaunched in October 2016. So the CCTB would be the first step. It seems to me more achievable in the near time goal than the CCCTB, but I think we're looking at more taking effect in 2019 for the CCTB and 2021 for the CCCTB. But actually, we've got some wide objections by member states, and I'm just going to finish this off, give you a little quote from Moscovici from Tuesday when he was in Ireland, and he said, Ireland can be reassured that there won't be a CCCTB if Ireland doesn't want it. So I think the consolidated corporate tax base is really far off. I can't see Ireland agreeing to it. We do need, again, a unanimous acceptance by the member states. So unlikely. We might see the CCTB, which Germany is objecting to because they don't like the R&D super deduction. So I still think lots of discussions going to take place before we see these coming through, Marlis.
Thank you very much for those insights, and I think that's very kind of good kind of news, very recent news on the CCCTB. So there's other good news also, the directive on mandatory and binding arbitration. So very shortly, what are your introductions? What are your expectations on introduction there? Susan?
Great. So yes, I'm just having to look for me. Yes, so the European Commission has actually now proposed a directive on the double taxation dispute resolution mechanism, and it focuses on double taxation dispute resolution between member states, but also broadens the scope to cover additional areas that were previously not covered, so going beyond transfer pricing and beyond the allocation of profits to permanent establishments. And it provides features to address certain identified shortcomings of the existing process to really enhance the enforceability and the effectiveness of the mechanism. So it's been submitted to the European Parliament for consultation and to the Council of the European Union for adoption. All member states will have to sign up to this proposal before it can be adopted, but we expect them to adopt it, and we expect it to come into force by the end of 2017. So we think that this will be agreed under the current Maltese presidency.
So that indeed is very good news to close off with. So Susan, thanks for the comprehensive and succinct overview of what's happening in the EU. A lot happening there. So now let's turn to the US tax reform and the impact of that reform on BEPS implementation. But before I turn to Kathy, I would like to ask the audience another polling question. So that polling question is, which team in your organization is driving the response to fundamental tax changes such as BEPS and US tax reform? And again, kind of the answers are on your screen, and we will come back to them kind of during our talk about the US tax reform. So now moving to that reform, as we have seen, Europe will not be the only reason where major developments are expected on tax in 2017. So during the elections, President Trump already indicated that tax reform is amongst his highest priorities. And Kathy can tell us what she's expecting to happen in the U.S. in the coming year or so. So Kathy, what do you expect? Kathy, are you still on?
Yes. It's going to be a big year for U.S. tax reform. The election of Donald Trump is certainly the headline. But the real key to tax reform was the Senate majority remaining Republican. A Republican House or Republican Senate mean that special rules, called reconciliation, can be used to pass a tax bill without any Democratic votes. That makes it so much easier to put together a bill that can be passed in both chambers. Add to that a president who is unlikely to veto a pro-business tax bill, and the prospects for tax reform change dramatically and suddenly. And this triumvirate of kind of Republican, Republican, Republican also will impact greatly the substance of the tax reform bill that we're going to see.
But the new president does have an enormous impact on the congressional agenda. So Kathy, can you talk about what the President Trump and the Republicans have identified as priorities for this first year in office?
I sure can, and they are, as they have been throughout the campaign, lots of rhetoric that was probably in papers worldwide. Number one, repeal the Affordable Care Act. To take that Obamacare, as it's referred to sometimes here, and repeal it and replace it, which will take a lot longer than just plain old repealing it. And that's going to impact our timeline for tax reform. The second priority for the administration and the Congress is to reform the tax system with emphasis on the international system. However, it was a very populist election, and individual taxes are also going to have to be addressed in this tax reform bill, making it bigger, more complicated, but ultimately more politically acceptable. Third is infrastructure. Every candidate and Congress has been talking about putting a lot of money into the infrastructure system in the U.S., and part of the funding for that could come from tax reform, so they are in effect linked. Regulatory reform is a constant battle cry of Republicans and many businesses in the U.S., and that has already started with some executive orders that have been signed by new President Trump over the last couple of days, as well as an executive order on immigration, which has been one of his big campaign messages. And finally, trade. Trade has taken a real beating in this campaign, I believe, on both sides, and it makes me sad personally. We just, quote, pulled out of the TPP, the Trans-Pacific Partnership. Not that we were in there yet. It hadn't been passed by the U.S. Senate, but there was a real kind of flourish of, Trump taking the U.S. out of that agreement that I think just happened yesterday.
Yeah, so kind of there's a lot of action already going on. And as you said, so the president has named healthcare as his first priority and tax as his second. And there will be a relationship, an interaction between these processes. So what do you expect that interaction to be?
Well, I believe that the nature and the tone of the repeal of health care and what the replacement looks like will have a great deal of impact on Democrats' willingness to help pass tax reform. It is also going to push the timeline for tax reform back. So I think, a health care process that was inclusive and doesn't deride the existing Obamacare could result in a smoother process for tax reform. A health care process that rips Obamacare out by its roots and kind of rubs salt in the wound of Democrats could result in a much more partisan tax reform process. And that is not necessarily going to be good for long-lasting, robust tax reform.
Yeah, that's a really good point. So if you then look at the president's plan, what are the chances of the president's priorities actually being enacted? Is there a track record there?
There's a very good track record, Marlise. The first major piece of economic legislation of the 5 most recent presidents contained major tax provisions, major tax changes, and they were all enacted within the first year of taking office. So this reflects the fact that in American politics, the first year of a president's administration is the honeymoon. Subsequent years may also be honeymoon, but the first year, everybody kind of gives him a pass, and his party will generally stick with him. And we see that happen the last 5 administrations. And I want to point out to the audience that 3 of these big tax bills that were passed by our last 5 presidents in the first year of their terms were passed under the process of reconciliation. We see George Bush, Bill Clinton, George Bush, all using reconciliation. Again, reconciliation, just briefly, means that you don't have to do it with both Democrats and Republicans. A single party can push through a reconciliation bill under special rules. And that is very meaningful in this current situation where we have a Republican House, a Republican Senate, and a Republican president. The 3 parties that have to, combine on legislation are all like-minded. And that says a lot about what may happen at the end of the day.
Yeah, indeed. So it's very likely that we will see tax reform in the U.S. And before we look at this possible substance of such reform, I would like to take a look at the interesting responses we received on the polling question on which team in the organization is driving the response to fundamental tax changes like the U.S. tax reform and like BEPS. And if you look at that, it's interesting because the biggest kind of group is still saying tax is a compliance matter, so tax is the only one responding. So that's 33%, and only 7% says that it's actually taken up to the executive board level in view of the expected global strategic and reputational aspects of the BEPS initiative. So that's an interesting result given how much is going on in the world. So with that kind of indication of where our audience is, now let's move at the state of play of the tax reform in the 3 chambers that will determine the makeup of the bill. So what is the tax reform overall state of play?
The overall state of play is shown in this slide, and it's unusual that tax reform process being so in gear has so little detail and substance behind it. I mean, that is kind of why we have to look at the political chat, because we don't have much more than that. This election took us by surprise, and the House, the Senate were not quite ready with their plans and with their substance. So let's look at that. Mr. Trump, during his election, was actually quite unorthodox in his support for a worldwide system with a 15% rate and no deferral. Now, as time went on, he kind of veered closer to his party orthodoxy, talking about still a 15% income tax rate, which is that's the headline of that plan. Elective expensing for manufacturers. Anyone who elects immediate expensing loses their interest deduction. They don't, of course, want immediate expensing along with deductible interest would be a negative tax rate on those purchases. Most business tax provisions would be eliminated by Mr. Trump. And that is a very classic kind of lower the rate, broaden the base message that we hear in every tax reform process in the United States. Any reform that changes the international tax of kind of earned by U.S. multinationals going forward is always accompanied by a mandatory tax on pre-enactment accumulated foreign earnings. Mr. Trump said he would tax that at 10%. This repat tax would be mandatory. And he would also lower individual tax rates. Now, these are just top lines. We haven't seen paper. We haven't seen a plan. We haven't seen the kind of thing from a Trump administration that we might have seen in a more developed tax plan a couple months down the road. The House does have a plan. They have what they call the blueprint for tax reform. It is 35 pages, very high level. Again, they weren't expecting to be in this serious a tax reform process this soon. So the blueprint for tax reform is 35 pages where they do lay out their top-line messages and their goals. So this is our most developed plan at the moment. As I call it, it's the only girl on the dance floor, so that's why people are very interested. Again, a lot of common themes between Trump and the House. Lower individual rates, 20%.
Yeah, sorry.
No, that's okay. Did you have a question?
Yeah, I have a question. So on those common factors, could you kind of shortly elaborate on kind of what are the key common factors?
The key common factors are lower rate, broader base, as some semblance of or some concept about expensing, whether it be for manufacturers or everybody, immediate expensing with elimination of interest deductibility, a repat tax. The House explicitly calls for a territorial system of taxation with 100% exemption. Trump has been less specific on that. And those are the common elements. Where the House kind of deviates or kind of breaks new ground is with their border adjustable tax system, which we will talk about in a minute. On the Senate side, which is the big, in my mind, missing link in this state of play, the Senate has yet to put out a plan or really kind of voice an opinion about where they want to be. And we have to look at three key people to see what's going to happen. That's the Senate Finance Committee Chairman, Orrin Hatch, and the two leaders of the Senate, Majority Leader McConnell and Minority Leader Schumer. We need to hear what these people are going to say before we really know where tax reform is going to land. And all we have is the chatter, the politics, the rhetoric. We don't have a plan on the Senate side, and they are an equal player in this game. Also, Mr. Trump has yet to really write anything down. We need to see who he's going to put in his treasury. We see Mnuchin being nominated, but we don't see any of the Assistant Secretary for Tax Policy, the Bob Stack of the future, for instance, the Mark Mazur of the future. We need to see who's going to really be in there before we really know what Trump plans outside the rhetoric that we hear in the news.
Yeah. So Kathy, yes. So that's indeed a lot of uncertainty. So with the limited time left, I would like to first move to our next slide, which is on the blueprint, and maybe you can emphasize kind of the most important issues there, and then I would like to go to the interaction between kind of what is going to happen with BEPS and what is the U.S. tax reform going to have an impact on that. So kind of if we move to the blueprint slide, which is slide 30.
Yes.
So what are the key issues there?
The key issues for the blueprint, we've discussed a little bit of the 20% rate, capital investment fully expensed, and accompanying elimination of interest deductibility. But what we haven't really drilled down on yet is the border adjustability, which would be a great big change for U.S. taxation. Under border adjustability in the House plan, it would exempt exports from taxation, and it would tax imports. There would be a territorial tax regime and tax on previously untaxed accumulated foreign earnings. And let's turn to the next slide.
So
talk a little bit more
drill
about
down
the blueprint.
on border adjustability a bit.
Yes, and that's on this next slide. What they would do under this border adjustability proposal is eliminate cost of goods sold deductions for any imported input into production. Our retailers are particularly concerned about this because a lot of the products that we sell in stores are imported. A lot of textiles, a lot of apparel, a lot of things like that. All the cost of goods sold that are imported goods or imported inputs, the deductions would be eliminated. For exporters, cost of goods sold would be fully deductible, and the sales revenue from an exported good would be totally deductible. So you have this very big difference between the treatment of exporters, who would still get cost of goods sold deductions and be able to exempt sales revenue from exports from taxation, and importers who would lose a cost of goods sold deduction and would be fully taxable on sales revenue. That is a huge change for U.S. taxation.
And I can imagine that really triggers a lot of uncertainty. And is that the key element of border adjustability, or is there any other element that is really important and that you can introduce in one sentence?
The key element of the House blueprint is border adjustability. And I think almost everyone that looks at the blueprint says, we see territorial, we see base broadening, we see lower rate, we see some kind of change in expensing. Those are common themes in U.S. tax reform discussions. What's different is the border adjustability, and that is what is going to be both the sticking point and the rallying point as this process moves forward. The Senate is not, we don't know what they think of it. Mr. Trump came out just last week and said he didn't like it. And the next day he said, well, we're going to look at it. This is really the current focus of our debate. But it won't be the focus, I'm going to predict, in another 6 months. This process is just beginning, and there'll be new phantoms that arise along the way that people are going to have to litigate in the Congress and in the arena of public opinion as this process goes along.
Yeah. So thank you very much, Kathy. I think that is indeed very interesting to watch, and kind of looking at that and looking at what's happening in BEPS. You can see some commonalities, and you can definitely also see some tensions. But I can imagine that it will take time before we can really say what the impact of the tax reform on BEPS is going to be, and whether it's going to be aligned or actually create tensions with BEPS. Is that correct, Kathy?
Yeah, it will be a while. The processes actually are likely to be, fortunately or unfortunately, completely independent of one another. U.S. lawmakers in the past were not exceedingly sensitive to the OECD or any other foreign pressure. State aid may be the exception because it began to impact U.S. firms. It remains to be seen if this trend will continue under the current administration. We don't yet know, exactly, again, who's going to be appointed to senior tax positions at the Treasury. And those appointments are going to be critical in this regard. We also, the details of tax reform still forming, so we can't really say whether the substance is going to be aligned or creates tension with BEPS. We do know there'll be a broadening of the base, and there'll be something on interest, and there will be developments that impact the way U.S. taxes the foreign earnings of its multinationals and how it views the income of its inbounds. I also realize there'll be many current provisions will be eliminated or repealed. So, I'm not talking about any tax administration proposals like FATCA and country-by-country reporting. Nobody's even hinted about changes in that arena. That's big. I want to be clear about that. On the other hand, it's also true that the tax writers have probably not gone down to this level of thinking about changes in the U.S. tax code yet. At this stage, it's not clear how U.S. tax reform is going to affect kind of international tax trends, and it will be interesting to see as that develops.
Yeah, indeed. So thanks very much, Kathy, for that overview of the U.S. developments. I think that gave a very interesting perspective, and I no doubt everyone will be looking out for the next developments. So I hope that there is more clarity on the Asian Pacific region that we will now be moving into. And again, before we go into the content, I would like to start with a polling question for the audience on an issue that will be discussed in this section, actually. So the question is, do the increased transparency requirements raise concerns for your business? And the answers are, again, on the screen, and please answer them, and we will come back to the results in a few minutes. So now moving to Asia Pacific, Joanne, could you give a quick overview of the developments in Asia? How is BEPS being perceived there?
So, Marlies, many countries in Asia Pacific, including Australia, China, Hong Kong, Singapore, India, and Indonesia, have all signed the inclusive framework under BEPS. We are showing a heat map on the screen, which consists of two parts. So when you come to the next slide, and part of the heat map, you can see that 75% of the countries have issued country-by-country reporting and transfer pricing documentation rule requirements, with Indonesia recently joining the list of countries. Tax administrations across the regions are now drafting new rules to implement the actions, identify priorities and resources required to implement the rules. In Asia, the feeling of BEPS is a combination of apprehension and uncertainty. At a country level, there is a high emphasis on the need to comply with BEPS. Taxpayers are awakening to the idea that inadequately administered transfer pricing can be costly. So there could be lengthy audits and transfer pricing adjustments, penalties, and consequently double taxation. So the attitudes of the in-house tax teams have to adapt very quickly, as they have to now move from a non-disclosure to now a full disclosure under BEPS.
So there's a lot happening in the APEC region. So Sean, Australia has traditionally been one of the few countries in the region involved in the OECD standard setting. How do you think the ATO has impacted the region? So what are the developments you are expecting in the coming 1 or 2 years?
The Asia-Pacific region is a varied region. There's a mix of high-tax developed countries which are very, very protective of their tax base. And the region also encompasses a range of developing countries that are prepared to use tax rates and concessions to attract growth and investment. As a result, the tax rates and approach of tax administrators vary significantly across the region. Australia has been very active in the BEPS project and was specifically involved in the development of a number of the BEPS action items. Some people would say that given the size of Australia, we're very much punched well above our weight in terms of the BEPS project. The ATO have very much embraced the initiatives and are actively using BEPS as a mechanism to change taxpayer behaviour in Australia. We're seeing much more engagement between the ATO and other revenue authorities within the region through the exchange of information. In taxpayer disputes, the ATO are seeking information in relation to regional and global value chains in an unprecedented manner. And in more recent times, we're seeing similar types of requests being made by other revenue authorities in the region. So certainly the approach of the ATO is being mirrored within the region, and I think there has to be a reasonable expectation for that to continue in the coming 12 to 18 months. We also expect that other countries within the region will consider the need for specific legislative reform to address a number of the BEPS action items, in particular Action Item 6, Action Item 7 and Action Item 2, to the extent the adoption of the multilateral instrument does not achieve some of the desired outcomes that are being sought.
So you have highlighted the importance of enhanced information exchange and transparency in the region, and Action 13 is requiring the most urgent attention at this moment, country-by-country reporting. So looking at the heat map, many countries, including countries that are not yet part of the inclusive framework on BEPS implementation, are introducing country-by-country requirements, or they have introduced them. So Joanne, how are enterprises in the region responding? What are some of the challenges faced by MNCs in the region on this?
We are seeing that larger national state-owned companies and listed companies are first to respond to these requirements. So resource constraint is a problem, and usually the work has to be outsourced. In view of the lack of a more detailed guidance, companies are considering a level of disclosure that is appropriate. So confidentiality is a concern. There is also a strong reaction to not over-disclose information. The second concern is transparency as a result of greater information availability. So historically, what is perceived as being aggressive tax planning is not something inherent in Asian headquarter companies. The focus in the coming year will be to align group structures and policies, as many of the Asian headquarters have in recent years undergone growth through overseas acquisition. So 2016 being the first year of BEPS, it is now too late to take any actions because the year has passed. So how to document the structure and policies as a transitional year will be very important.
it will indeed be important to take into account how enhanced transparency will impact existing tax structures. So, Sean, would you like to advise briefly on the practical structural issues that you have come across in this area?
Yeah, sure. And I guess from an Australian perspective, our existing CSC rules are generally regarded as being fairly robust and comprehensive. And as such, the use of no substance havens by Australian headquartered companies has not been as extensive as some of the other jurisdictions. That said, there are a number of specific areas in which Australian headquartered companies are having to consider as a result of greater transparency and some of the BEPS initiatives. These specific areas include the use of offshore marketing hubs. The ATO released a guidance paper only last week in relation to offshore marketing hubs, which will be very relevant for a number of multinationals, in particular those in the resource sector. The use of hybrid financing arrangements is going to be under scrutiny given Australia's endorsement of the anti-hybrid rules as released by the OECD. Legislation is expected, or draft legislation around that is expected in the coming months to take effect from 2018. And the other area in the outbound context is where companies are using offshore PE arrangements to achieve certain outcomes, which is another focus from an ATO perspective. And the focus of the ATO is very much driven by some of the transparency and greater access to information that the ATO now is seeking and having. In the inbound context, the ATO has shown a lot of interest in structures involving lower or no tax jurisdictions involving limited economic substance, and we expect that the CBCR will highlight some more of these structures, and the ATO and other revenue authorities in the region will be undertaking further examination for companies using those types of structures.
Yeah, so thanks, Sean. So it may be good to cover the poll results now, and that came back on the concerns in relation to transparency. And what we see there is indeed that kind of a majority is concerned. 41% is concerned with how the tax authorities will interpret the information. 26% has confidentiality concerns, and probably kind of there's a mix. And only 12% think that the transparency is actually beneficial and will create fair competition. So with that said, let's now move to Joanne. So Joanne, China was an active participant in the BEPS project. On the ground in China, what are you hearing? Can you very briefly say what the major priorities are in China and how you think China will achieve these goals?
So, Marlies, I think we heard before 2017 will be a challenging year for international tax cooperation. And with the SAT views at high level, the ultimate goal is consistent with OECD, which is to promote economic growth, but also to achieve fairness in economy and taxation. But I think the challenges and the difficulties for domestic government is to achieve neutrality, whereby their BEPS action will not be viewed as extreme and drive away potential investment. So we expect the SAT will be issuing new regulation in the coming period, but maybe over a period of time. And their main focus right now will be to decipher what is useful information from CBCR, master file, and local file, and to utilize the information to achieve their goal.
Okay, so also there on China, a lot happening. So let's move to Australia now, to slide 36. So there, now that Australia has, we've seen ATO lead BEPS in the region. Australia has taken a front-runner role. Could you talk about the background and reactions? Where is the ATO moving in the coming years, and you know, what can we expect there?
Yeah, sure, Marlies. I think, you know, as we've mentioned, Australia has been on the front line in relation to the endorsement and adoption of BEPS-related developments. In addition to agreeing to the various transfer pricing related action items, the Australian government has legislated the Multinational Anti-Avoidance Law, or MAL. That law's to apply to foreign multinationals generating certain profits from Australia with a structure that's avoided an Australian PE. And there's been recent announcements and draft law in relation to the diverted profits tax, and an announcement in relation to the future implementation of the anti-hybrid rules. Much of these announcements and drafting has been based on the UK law, and we expect that to continue. In terms of the background, there's no doubt that the political pressure has been a key driver in relation to the development of the BEPS initiatives, such as the MAL and the proposed DPT in Australia. The subdued economic environment, the decline of the resources sector in Australia, and the associated reduction of the corporate tax collection has resulted in an unprecedented focus by advocacy groups on the tax affairs of multinationals. And as a result of this focus, there's a continuing Senate inquiry into corporate tax. The government's established a tax avoidance task force within the ATO and provided significant funding to the ATO to enhance and extend current compliance activities. As part of this task force, the ATO is recruiting senior resources from both industry and the profession. As a result of this pressure and continued public focus, the ATO are actively and aggressively pursuing multinationals, and we expect that to continue in the next 12 to 24 months. At a very practical level, we're seeing the ATO seek to leverage the uncertainty created by some of the legislative changes to influence taxpayer behaviour. In addition to the increased scrutiny in relation to TP outcomes in key industries such as tech and pharma, I think we'll continue to see the ATO focus on Action Item 7, Action Item 6 and Action Item 2. And I think importantly, the challenge for taxpayers when dealing with the ATO in Australia and certainly in other jurisdictions in dispute scenarios is the willingness and ability of the ATO and revenue authorities to attempt to use the uncertainty and broad nature of some of this new legislation with the threat of penalties and further audit activity to negotiate outcomes on a non-technical basis. So I think, Marlies, they're the...
Yeah. So sorry, Sean. I'm afraid
no,
So thanks very much for that overview. A lot happening in Australia. So let's now go back to China for our final part on the Asia-Pacific region. So Joanne, what main developments will we expect to see in China in the coming 1 or 2 years?
I would say in China right now, the authorities are looking at resources, and they will be empowering local tax bureau to cope with the increased BEPS work. And then we will also expect changes in how BEPS will be enforced in the next 1 to 2 years in terms of the procedure and also the analysis approach to look at transfer pricing. And I think one more point worth mentioning is that we've heard a lot about location-specific advantages, but I think with the environment changing right now, economic downturn, and also the location differentiation is also disappearing with other countries in the region renewing itself. I would say that there may be a change in the way they look at some of these earlier concepts.
So thank you very much on that. So, Sean, if you now look at what's happening, what is there any other specificity that you expect in the Chinese region, especially in relation to transfer pricing and maybe the DMP functions, Joanne?
So yes, Marlies, I think in China we have the DMPEP functions where there's an additional P added to take into account the promotional activities in China. So this is new under BEPS, but we observe that the SAT, they may have a different interpretation towards the way they look at these analysis. So, we also understand that the SAT, they have greater emphasis on value contribution. And rather than taking a one-sided analysis like a TNMM, we understand that they may have a preference over the profit split for the profit split approach towards looking at some of the transfer pricing position. So I think on this aspect, I would say that going forward, we may expect the tax authorities to look more at the different, to look at the analysis of the different parts of the supply chain. So at different turns of the supply chain, they may expect to see more analysis as opposed to just the result, which is a simple tested party TNMM approach towards transfer pricing documentation.
So thank you very much, Sean and Kathy and Susan and Joanne for the overviews on the regions. I would now like to move to the wrap-up. I'm afraid we don't have time for audience questions. I hope the webcast provided you with an overall picture on where we are in the post-BEPS world and what to look out for in 2017. It is very clear that we are in the post-BEPS world and that we need good information and tools to navigate it. That's actually essential. Managing and preventing controversies will be important processes in the post-BEPS world, and therefore that will be the subject of the next webcast. And we hope that all 3,400 that registered for this webcast will also be on the next one, which will be on this issue of mutual agreement procedures and bilateral and multilateral APAs. So that will be on February 16th. For now, I would like to thank the audience for tuning into the webcast. I would like to thank our excellent panelists for their contributions and giving the overview on what is happening worldwide. Please do not hesitate to contact us, and you will find details on where to contact us on the slides. A on-demand version of the webcast will be available shortly, so you can look back to it. And before you sign off, please click on the feedback link and give us feedback on this webcast. And further, if you have been with us for 90 minutes and you've answered all the polling questions, please also go to the purple CFE icon for your points. So thank you very much. Goodbye, and have a very good day, night, evening, or morning. Thank you. Bye-bye.